From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 30th, 2023. Wow, the summer is half over. Let's check the calendar. Yep, the summer is half over. This weekend, the Brewers are in Pittsburgh. Then the Cubs are here for 4 games starting Monday. And it's the second weekend of Summerfest. Tonight's headliner is the great R&B group Earth, Wind & Fire. Tomorrow is Boogie with the Hoodie. I don't know anything about that act, but I like their name. Let's start with a woman in Ohio who has a great sense of humor. She has a 9.5-foot tall werewolf in her front yard. It started last Halloween, but he was such a hit that she's keeping him up all year round. She dresses him up for the holidays and special events. For this summer, he's wearing a Hawaiian shirt with oversized sunglasses. He looks just like Tom Selleck. An American family living in England is looking to hire a dog nanny. Here are the benefits. You get to live in their estate, and you get paid $127,000 a year. And you get 6 weeks of paid vacation. And the line forms right behind me. A man in China has been fired for taking too many bathroom breaks. He spent up to 6 hours of his 8-hour shift in the bathroom. I think we have a new poster boy for quiet quitting. A man walked into a convenience store wearing a mask and a wig and flashing a pistol. But it wasn't a real gun. It was a pistol-shaped controller from the 1980s Nintendo game Duck Hunt. So I'm guessing the cops are looking for Elmer Fudd. And finally, Britain seagulls have developed a taste for a new strain of hybrid marijuana. There's an increasing number of seagulls swooping down on the beach and snatching the drug user's stash. The effects of this hybrid are so acute, users have been compared to zombies. Man, there's nothing worse than a drug-using paranoid zombie seagull. Or so I've been told. On the podcast, we have Art Rothschild, Max Hoelzl Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thank you as always, Max. Another strong week to put a cap on what was a strong quarter, a strong first half of the year. The NASDAQ up 2.2% this week, closing at 13,788. The S&P up 2.3%, closing at 4450. Setting another new high for the year, the Dow Jones Industrial Average closed this week at 34,406, up 2%. For the year, the Dow now up 4.9, the S&P up 16.8, and the NASDAQ, again, as we seem to keep pointing out from week to week, maybe not all that reflective of the broader economy, but the NASDAQ up a stellar 32.3%. Joel, I don't always start with you, but some things caught my eye that I think may be in part a reflection of some of the strength we've seen in the stock market earlier this year, so far at least. We got consumer sentiment numbers as well as consumer confidence numbers this week. Consumers seem to be feeling a little bit better about what's going on out there.
That's right, Kyle, and don't start with me. We always point out that consumer spending rides 2/3 of the gross domestic product, of the economic engine of our economy. And so those two reports that came out this week both showed that consumer confidence, consumer sentiment are up. And the consumer sentiment numbers from the University of Michigan, they pointed out that a lot of it is because of the bad attitudes that people had with the debt ceiling debate earlier in the month. And now that that's settled, at least for now, people feel a lot better. And it doesn't hurt that inflation's going down. We had reports this week that, inflation keeps going down thanks to the Fed's work at raising interest rates to slow the economy. And consumers, according to these reports, are feeling better about the economy because of that.
And I think as we look, Art, at what has been an incredible start to the year, certainly consumers feeling a little better about it's a good sign. But more broadly, investors should be pretty excited about just how strong of a first half it's been.
Yeah, an incredible first half. As you've mentioned in some of our discussions previously, forget about the adage, sell in May and go away. Thank God, we're in the game, number one. Number two, good news, is good news again. And there are more economic indicators that I think Joel's going to be able to go over that suggest to us why things are doing well. And then there's the self-fulfilling prophecy. When the market starts to go up, it could keep going higher to a certain extent. And furthermore, given that the gains have been concentrated with the NASDAQ of 32%, so far this year, I mean, that'd be a good year. Just stop right there. But it doesn't have to. Momentum could carry it higher. And the Dow lagging, being only up 5% roughly for the year, it was nowhere, a few weeks ago. So I think there's a lot for long-term investors to be enthusiastic about, not to mention the wealth effect, which we haven't mentioned in a while. This is contrary to what the Fed really wants. They don't want people to be feeling better. These consumer confidence numbers mean that people are probably going to be spending more than they're even saying they're going to be spending, which means the Fed's probably going to have to continue to raise interest rates, which investors haven't liked but are beginning to accept. So I think we could have more gains ahead. That's my own personal view.
And what's so interesting about that is, Mike, we've spent a good chunk of the year talking about just how important balance is, just how important it is to keep in perspective that there are certain reasons why you do things other than stock. It hurts sometimes when the market's up as much as it is to know that you could have put more at risk, you could have participated more in the gains. And yet from the early days of this year, even going into late last year, we were talking about the importance of cash. Well, yeah, getting paid a little bit on cash doesn't feel as good as, up 32% on the NASDAQ. Let's forget for a second that that's not the vast majority of what we actually see in the market. But even still, I think this is an important reminder that cash still plays a role.
Yeah, I mean, I know Art has said this previously with this year, but this time cash is king right now for a lot of people. And you're right, it is attractive for a lot of people to see they're getting 4.5, 4.8, even close to 5 on some money markets, and think I need to pour all my money into cash because, especially after last year, right? I mean, last year was just a 12-month kick in the teeth for everyone with all the ups and downs, that if you can say I can put a lot of my money and just know I'm getting 5%, that's a good thing. But to your point, you can't, it's a good to take part of it, but to your point, you're now sacrificing your long-term upside approach because, as we've always said, stocks will come back. The market always comes back. So while cash is attractive, and I have been using it for some clients, because if they can take a portion of their portfolio and just put it away, no, on this 10% of my portfolio, I'm getting, like I said, 4.5, 5%. It helps them sleep at night, but you always have to remind them when the market comes back, if you try and time it, you're going to be late. So keep it in stocks, stay patient, and enjoy the ride when it comes along. Well,
and I think what I appreciate about this conversation is, those of us at the table right now, not maybe unfamiliar with the occasional poker hand or friendly sports wager.
I have no idea what you're talking about.
And there's this tendency in gambling to chase, right? That you lose a hand, and in poker you call it going on tilt, right? That you chase that opportunity. The next time you've got an okay hand, you're throwing money at something you probably shouldn't be throwing money at because you're not using your head. And investing follows some of the same principles in that, there's this fear now that, well, you missed out on the first half, and so you got to just double down now to get back what you missed out on earlier on. That's where the risk starts to come in. That you had a strategy coming into the year that not everything was up 30%. Some of it was up 2 or 3. It was up 2 or 3 for a reason because that was part of the plan. And if it's cash for the sake of having cash, the plan doesn't change simply because the returns on stocks looked a little better than we thought it did in the first half of the year. I think as we look ahead, one of the real challenges we continue to have, as Art, you pointed out, is how we navigate what the Fed's doing. It's been so interesting to me that the market investors have been very willing to suggest that the Fed's going to have to slow the pace, the Fed's going to have to cut rates. And you juxtapose that with what the Fed is actually saying, with what Jay Powell said this week or last week, that no, actually rates may stay higher for longer, maybe a sign that the economy's a little stronger than most people think?
Yeah, I think it's also interesting news that came out this week that Chairman Powell may indeed be a deadhead. He was spotted at a Grateful Dead successor, whatever the group is called, concert, which reminds me of the line, "What a long, strange trip it's been." You can't play this year to year. You can't play it 6 months to 6 months. We play a long game. Mike and I were talking about this earlier. The Fed's going to do its job, and they've proven that, and they've proven they're going to continue to do it. And when you look at the interplay of the things we've talked about, cash makes you feel better. Cash is giving a good yield. That's why it's part of our portfolios. Last year was a terrible year. Stock market dropped 18%, worst year since 2008. Nobody would have expected this to happen. Well, we don't have to because we ride through all of this. Joel's comments about the consumers finally at least saying they're a little more confident, thank God the debt ceiling crisis didn't blow up. What happens now when they start realizing, Mike and I have talked about this on a regular basis, they don't realize how much money they're making. So that's when this wealth effect thing's going to kick in. So I don't think they care how much the Fed's going to raise rates. They're going to keep spending. So the trick is, when are the inflationary pressures going to subside? And as Chairman Powell suggested this week, it may not be for a couple of years. So as you suggested, just expect interest rates to perhaps go a little higher for a little longer, but don't expect the Fed to back down. I won't back down. That was not a Grateful Dead lyric.
Tom Petty.
Yeah, it was.
We've turned this into a music podcast,
We
though.
could.
I think.
Should I start singing? No.
What's so
Maxwell, we'll do a duet.
Thank you.
What's so incredible to me about all of this is, I think you point out, investors don't even have their second quarter statement yet. They haven't even seen those numbers. They'll see them soon enough. So depending on when you're listening to us, you may already be getting that email that says, hey, come check out what we've done so far. And I think pleasantly surprised for the most part, as I look at client portfolios, very few areas where there's negative numbers anymore. Whether you're looking at a rolling 1 year, whether you're looking at year to date, the vast majority of stuff out there is making money, and that's a more encouraging place to be. Maybe it drives some of what we were talking about earlier with consumer sentiment. Maybe it drives some of this climbing a wall of worry, because we've got a lot of concerns about what's going on out there in the world, and yet none of them seem to have materialized to the same extent that we thought they would. And so I think, if nothing else, I'm encouraged by that.
Remember, Kyle, we were thinking that there was going to be a recession this year, and so far we're not seeing that. So far a lot of those predictions are backing off, and they're saying, well, maybe later.
Yeah, I think we have to be clear that there will be a recession. We're not going to get around the inevitability of the economy slowing down. The risk is in putting a time on that, and the risk is in saying, here's how bad it's going to get when it gets bad. And I think early on there were some forecasts that suggested that we'd be talking about it in summer or early fall. It seems for now like maybe we've pushed that off further. It seems for now like whatever that looks like down the road is a little less scary than what we thought it was going to be 6 months ago. But the economic data has been strong enough to make that less of a concern. The other side of this is that, in a sense, we're in a recession. We're in an earnings recession right now. Second quarter earnings will kick off in a couple of weeks. It's likely to be another quarter of year-over-year decline in corporate earnings. They're still making money. They're just not making as much. And in many ways, I think that's part of what last year's sell-off was about. That we're talking about an environment in which there was some weakness that maybe wasn't represented in the economy more broadly because it came in different areas at different times. But if the real concern is that the economy falls apart, that seems to have been pushed off for now. Joel, we got a couple of other pieces of economic news. The big ones that stand out to me, given the scope, new home sales, existing home sales, just a sign that housing, I guess, doing more of the same still.
Right. Yeah. There were a number of things this week where the near term look at what's going on, those near term trends are looking positive, even though longer term, it's showing that the economy has weakened over the last year. We had numbers on new home sales. Those are up for the third month in a row, seventh time in 8 months. So the pace is picking up there. But if you look at it, it's the median sale price for a home is down 8% from the year before, which suggests that demand is lower, and so prices are going down. And the same thing with the S&P CoreLogic Case-Shiller Home Price Index. Year to year, that's the first time that the price increase, or the price hasn't increased. The first time that's happened since 2012. Every month it's happened year to year since 2012. But the people who run that index say that they're seeing suggestions that in the shorter term, the last few months have shown a recovery in housing prices.
And a third estimate of first quarter GDP, a little better than we thought. Buried in those numbers, information on personal consumption expenditure index, what the Fed looks at with respect to inflation. A pretty dated number by now. We got an update from later in the week on PCE that shows a little bit more decline.
Right, yeah. So today, actually, the Bureau of Economic Analysis showed that the year-to-year price PCE index is up 3.8%. That's from May of 2022. That's the lowest increase it's been since April of 2021. So that's pretty. And remember, last June, so a year ago, that number was at 7%. So it's come down. It's still not at 2%, which is what the Fed wants. But they still have work to do, but they've made some progress.
I think that continues to be the key. It's what Art talked about. It's what Mike talks about. It's what we've talked about at length, is that we set a target of 2% for inflation. We've got some clear ways that we measure it. Always a lot of noise about how we measure, when we measure, why we measure. But ultimately, that 2% target's been a pretty long-standing one. The Fed has been clear that that's the objective. They've been clear that they're going to do what it takes to get there. And so far, we've been able to navigate that without too much trouble. I think the best evidence of that is just how strong the start of this year has been. So I think as we kind of close the podcast for today, ahead of the 4th of July weekend, a happy 4th, a safe 4th to everybody. Hopefully the smoke clears enough for the fireworks to create some more. And we can all have another great half as we get ready for the second half of 2023. Thanks for listening. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.